again, the numbers have been mixed, and in fact, even in a sector like IT, where we thought that the performance would be much better than in comparison to the peers, etc. Infosys has come out with better results, but TCS disappointed. So you tend to see these results which has come about a mixed bag. Again, Wipro is a neutral. Tech Mahindra has given a results which was better than what was anticipated after the profit warning that they gave. So here you have even in an IT pack itself the results being mixed, and so is the case with most of the other sectors where headwinds are still there on the rural consumption side. Now the key question is, there has been some benefit thanks to the low commodity prices, and the commodity prices continuing to remain subdued has probably given a respite to EBITDA margins in certain sectors, but overall it's more or less in line with the expectations. And our call on the market or on the index has been what we expected to move in a trading range between 7,800 to 8,800, and here we are exactly in the middle.
Right. Sreesankar, from whatever you heard of corporate earnings so far, is there any evidence to sort of tell you that the domestic economy is showing signs of recovery? Are you seeing visible signs of turnaround in some of the pockets that have been hurting for a long time, like infrastructure, power, and so on?
Okay, this question I'll take it in two parts. One, from the results are we seeing? The answer is no. Now, the next point is, post the results, most companies do have a conference call with the analyst on the results. In that analyst conference call, some of the people have actually come back and said that there are indications that things are beginning to look better. So now, when the next question is, when will you see that starting to impact or benefiting in the company's performance going forward? So our own expectations is, by the time this gets reflected completely, it will be to end of second quarter and beginning of third quarter, etc. So you probably will see these kind of numbers getting reflected in the earnings growth probably in second half or towards the end of the current quarter. So it's going to be a time consuming. I don't think that the optimism that's being seen is not yet reflected in the quarterly numbers the companies have come in. Now you ask the question of infrastructure. Again, infrastructure is a generic term for me, because there are roads, there are power plants and everything within infrastructure. So you are actually beginning to see that from a point of view, the more number of orders that is getting released for roads, etc., has started to improve, and probably the pace at which those orders are coming out is not something that you are very happy about. You probably would love to see even a higher or a faster pace at these kind of stuff. But I think that's still happening. It's happening out there.
Okay. What about banks? What are you expecting from banks this time? Even if you split between the public sector guys and the private sector banks, from an asset quality standpoint, are you expecting any mitigation?
Not at all. In fact, we continue to believe that in the public sector space there is going to be more pain, and that pain will continue to happen. The only difference is, sorry, in the earlier quarters you probably would have seen as restructure. From this quarter you probably will see it in terms of NPAs. So you have a mixed bag. When the private sector banks in general has come out with better asset quality, lower slippages when compared to some of the or when compared to most of the public sector banks. I think that differentiation will continue.
So, what should investors be doing right now, Sreesankar? Are you seeing most people stay in cash, waiting for this volatility to play out? What's your advice?
See, the way when we look at this entire investment horizon, what is happening, let's also look into the perspective of it. One is India as a country per se. Second, India as a country within the overall realm of emerging markets. Within the emerging markets, we've had a situation, BRICS as the Brazil, Russia, India, China as the countries, where probably you will see the fastest growth in economy. Now let's look into Brazil and Russia, and first two countries in the part of the BRICS. You have Brazil has gone through the currency depreciation of 40% plus in the last 12 months. Then you have Russia, which has gone through 65% plus in the last 12 months. So effectively, these two countries are looking at a contraction in the economy over there. So then you are left with Russia and China among the larger countries. So India and China and the larger countries. Now, India continue to grow, not at a pace at which we would have loved, but at a pace which is still growing. But China, you're seeing actually more contraction or challenges coming in. So you got from a global investor's perspective, from the investable pool that he has got, India as in a better economic or a better management sense to see larger investments or larger money coming into this market on a relative basis. Then you look at other countries in the emerging markets universe, South Africa, Indonesia, Malaysia, to name a lot of these countries. Everybody has got its own their own problems rather. So on a relative basis, I think India is very well placed. India is a large importer of crude. The crude prices continue to remain benign and subdued, let me put it up that way. So if you continue to see crude prices remain soft, India is one of the biggest beneficiaries because your current account deficit is relatively on the better wicket. Well, that's where I think India as a country will continue to see an advantage, and on a relative basis the price earning multiples will expand. This is where I think one needs to look at it. Domestic economy growing will be an added catalyst to the market at that point of time.
We'll leave it there, Sreesankar. Good talking to you as always. Thank you so much for your time. Sreesankar from Prabhudas, Lilladher, talking about the Indian markets in relative terms to emerging global markets. But for today,